We've known how crypto functions in a low interest rate or zero interest rate environment, and now we're finding out how it functions in a higher interest rate environment. So we've got some experts speaking here, Rich Gupta, and we're gonna have Robert Levin, Mark Heil's leading the discussion. We're gonna go for 40 minutes and we'll go from there. Mark?
Well, thank you, Marty. Greatly appreciate it. Hello to everybody in San Francisco. It's a pleasure to join you this afternoon. As Marty has already introduced, we're Rich Gupta, partner of Rama Crowd Capital, and Robert Levin, CEO of Emerging Star Capital, will be speaking this afternoon. They are subject experts on this topic, and I'm looking forward to this conversation. Today, we'll be discussing not only the coins, the crypto hedge funds, regulations, and of course, DeFi, DApps, Meta 3.0. So some of this is going to overlap with the excellent job you just heard Arthur, Julia, and Joel speak about. But a lot of this will be different and new. And even yesterday, Rich spoke on a panel on healthcare. There was a lot of discussion of blockchain there. So we'll revisit some of that discussion from yesterday. My name is Mark Heil. I'm with the institutional sales for Pacific Premier Trust, a division of Premier Bank, formerly known as Pensco. We are the leading alternative asset custodian with 18 billion in AUC. We like to target, people like to use retirement dollars to invest in alternatives due to the illiquid nature of alternatives. And so you get longer term plays with your retirement dollars and the tax benefits that come with those. I'm part of the institutional team. We work with asset managers, RAs, broker dealers, and family offices. Just some quick examples. We're doing fund custody for a $3 billion fund out on the West Coast. It's a credit fund. We've also worked with an RA. We work with several RAs, helping them get investments into alternatives. This one particular RA formed an SPV. It was about a $50 million SPV, and about 15 million of that 50 million came through us, which was all through retirement funds. But enough about me. I do have one thing I have to do, working for a trust company, which is owned by a bank, 2 sets of lawyers, so I have to read a disclosure. This applies obviously to everybody online. Information presented is for educational purposes only and is not intended as, it may not be relied upon as, tax, legal, investment, or other advice. Pacific Premier Trust performs the duties of a custodian and as such does not evaluate, recommend, or endorse any particular investment strategies. You are advised to consult your professional advisors for specific guidance regarding your investments. Investments are not FDIC insured and are subject to risk, including the loss of principal. This afternoon, we're going to have a discussion here. I would like it to be a discussion rather than just me asking Rich and Robert different questions, but obviously I'll prompt them with questions. This is not a political discussion, but a financial discussion. So please, when you're asking your questions, let's keep to the finance. Having said all that, let's do some quick introductions here. Rich, would you introduce yourself? Tell us a little bit about your background and Rama Crowd Capital, please.
Thank you, Mark. Appreciated the introduction, and your disclaimer applies to us as well. This is not an advice to buy or sell, more educational. After spending quite a bit of time in Manhattan running and managing massive capital market transaction groups, landed in West Coast in 2004-2005 timeframe to create a new alternative investment platform. And then we all know what happened in 2007 and 2008. Since then, became pretty much independent transaction provider. And then we formed a Rama Crowd Capital is nothing but a MFO structure for 7 of us, where we look at transaction mostly in fintech, health tech, anything blockchain and crypto assets, as well as focusing on building transaction flows for OTC trading in crypto assets. And we're also looking to build an alternative investment for real estate, which previous participants were talking about, and building a basically soups to nut blockchain solution for alternative investments and alternative lending. So that's about me. I give it back to you, Mark.
Terrific. Robert, I'm going to ask you to do the same thing. tell us a little bit about your background, and it's quite an impressive one, as well as Emerging Star Capital, if you would.
Great, thank you so much. So my background is on Wall Street for 15 years and 15 years in technology. I worked for my family's firm on Wall Street, which was a multinational commodities trading firm where I traded futures and hedged exposures in physical commodities and did macro analysis. We subscribed to Ray Dalio's daily observations. So he came in once a month and was one of my mentors in global macro. Then I worked for Solomon Brothers, and then I worked for Louis Bacon, a really brilliant macro trader, as well as for Paul Tudor Jones, equally brilliant, and ended up raising some money for Louis, and went on to work in marketing CTAs, and then went into technology, into artificial intelligence. So I was a pioneer in artificial intelligence and became a tech pioneer of the World Economic Forum. And then I decided to go into digital assets. So that's my background. And Emerging Star has a fund which launched, is up over 30% since inception, April 1st, because we're focused on SAFs before they get liquidity events.
Awesome.
Terrific, terrific. So, all right. Well, let's sort of get this discussion started. I like to focus on the coins and then build out there into all the other areas of crypto, including NFTs, security tokens, DeFi, DApps, all that good stuff. And I guess about 6 months ago, I was struck by this thought that Bitcoin was the new gold, and you should buy crypto as a hedge against the economy. And obviously that hasn't played out. So I was wondering if you could provide some insight as to what exactly happened there and what went on. I don't care, Robert or Rich, either one of you, feel free to take the question.
I'll push back a little bit, whether it's a digital gold or either Bitcoin is a digital currency or digital energy. Those are the names loosely aligned for Bitcoin and crypto assets. And Bitcoin itself has shown over the course of decade plus of institutional adoption as well adoption in general public as well. The price fluctuation for any industry, if you look at from the gold industry to, Robert can speak to commodity industry, I don't have much experience there. But gold, if you look at the early days of gold pricing, fluctuations and deviation and variation on pricing of gold was very common in early days of gold. I'm talking about 1800s, not now, not currently priced at what we see gold as a more stable price. So yes, currently we are seeing Bitcoin and other crypto assets in some volatility environment where the prices have dropped. Bitcoin has dropped almost 60%, other assets have dropped 60, 80, 90%. Depends on which crypto transaction, which crypto asset we are talking about here. But Bitcoin as a whole, is which we are very big proponent of, is a most reliable digital energy, digital currency for the futures to come.
Robert, anything to add to that?
Sure. So there's a new bill in the Senate that is trying to clarify the terminology of crypto and where it should be regulated as a commodity, a derivative, or as a security. So it's called the Responsible Financial Innovation Act. And so they're trying to distinguish between different types of digital assets, stable coins and pure virtual currencies that are not backed by any asset. So, and also the degree of centralization. So as the Loomis and Christian Gillibrand bill in the Senate goes forward, we're going to see more clarity with regard to which jurisdictions for which definitions of digital assets will be regulated.
That's correct.
And I've heard a lot of people say this is going to grease the tracks for for a U.S. spot Bitcoin or Bitcoin spot ETF. Do you agree with that?
Well, I mean, if you take into the ETF environment as a whole, ETF is a security transaction managed and supervised by SEC. And also associated exchanges, which are trading ETFs or OTC market, are somehow supervised by SEC/FINRA and those organizations. Now you look into the Bitcoin environment, the crypto environment, who has the jurisdiction, as Robert alluded to, the laws in the United States is still being corrected and implemented. And we are eagerly waiting for Cynthia Loomis and Kristen Gillibrand's latest solution of legislation to move through. And we are sure it will go through multiple changes. But SEC, if you sit on SEC's shoes, how do you allow for a spot ETF if you don't have supervisory skills, supervisory views of underlying institutions like exchanges? Who controls exchanges? Who is supervising them? We don't have clarity of it. So that's the holdup on spot ETF versus you've seen commodity CFTC has originated ETF, which is actively traded in the marketplace. And that's what I would state on that side.
Yeah, and I think you brought up a very interesting point, especially considering the recent history with Terra. The Terra UST and Luna collapses of last month. Obviously, that has caused some of the downward pressure on cryptos, as well as just the general economy. So I guess my question to you, Robert, is is this bill going to help lead the way for institutional money to come into the market?
So for assets that are fully decentralized, like DAOs, and nearly decentralized, the answer is yes, it's going to bring in a lot of institutional money. And the same, I believe, is true for regulated assets as securities. You're going to see more institutions come in, but we have to have a capitulation bottom followed by a key reversal in this downtrend. And the downtrend's driven by macro considerations, higher interest rates, higher oil prices, a slowdown in the world economy. But China's speeding up. It just came out of lockdown. So I think that we're going to see China as a stimulus to the world economy as it comes out of lockdown. But they're going to drive energy prices higher. And so short term, we have stagflation. So that's not a good environment for digital assets. But there are opportunities because over $41 billion has gone into private equity venture capital, pre-IPO equity. In the venture side, Andreessen Horowitz, Union Square Ventures, and other top venture capital firms have led the way in creating digital infrastructure. So that's going to create a very strong foundation for recovery because there's going to be a mainstream adoption of crypto assets and smart contracts. So I'm bullish intermediate long-term, bearish short-term.
And Rich, is that your general outlook or do you have a different take on this?
I agree with that. I mean, generally, as we are going through massive correction, we anticipate within the 6 to 12 months, there will be clarity on regulation. There will be clarity on stablecoin, which has become the primary source of currency to trade on DeFi and other asset classes. And we can discuss stablecoin as you asked the questions, but I'm in 100% agreement with Robert's assumptions as well.
Thank you.
Okay, so taking a look at this legislation, I mean, it touches on a few different areas. First off, it encourages the use of digital currency as a means of exchange, provides a framework for differentiating, as Robert touched on, between a commodity and a security. Again, that comes down to the Howey test. Defines an ancillary asset as an intangible fungible asset that is offered, sold, or provided to a person in connection with the purchase of a sale or security through an arrangement or a scheme that constitutes an investment contract. Requires ancillary asset disclosures that have to be filed twice a year with the SEC. So thinking about this, is this bill going to cover enough, or is there still more regulation that's going to be needed?
So number one, it's a 70-page bill. It'll probably be broken up into 3 different bills. 2, it does cover and distinguish between different types of digital assets, including asset-backed assets, mainly stable coins, but also gold-backed tokens and other assets that will be backing digital currencies. It does not cover central bank digital currencies backed by the full faith and credit of each national sovereign entity. So, but that we already have 9 pilots out of 90 countries that are considering adopting digital currencies issued by central banks. So that is not covered by the bill. But I think this is a very important bill that has a very broad scope, but it's poorly understood by Congress. 78% of members of Congress are attorneys without a tech background, and most of their staff don't have a tech background. They know what an algorithm is, but they don't necessarily understand how to regulate algorithms.
Understood.
Agreed to that point. I think the challenge is, as I describe it, the United States economy and regulatory environment is similar to a big ocean liner. It's a steady flow. It's not going to be speedboat. It will eventually get done. We do, as the industry participant, want clarity of regulation, clarity of laws, and clarity of compliance, not just execution and assumption that we should be following certain things without any clarity. So this is the first attempt. There is attempt in Congress as well, and I'm missing the congressman names, and they are also attempting to create a legislation for crypto industry as a whole, focused mostly on all the asset class, which Senate bill also talks about. So there is finally more movement. I mean, if you look at as Robert agreed, I would agree with Robert that majority of the Congress and Senator folks are either lawyer or some business people as well and doctors, but they don't have a clarity of how to legislate algos or ideas. Like Bitcoin is an idea and algo based and is operational in pretty much every part of the globe. How do you legislate that? So other than enhancing the regulatory environment for KYC AML and adopting those clarity rules on deposits and lending, we can talk about deposit and lending, what happened to BlockFi, and all those clarities are needed.
Yeah, no, I agree. I mean, it's a very interesting area. It's dynamic, but I also agree with what Robert said, that this is a good first attempt at really bringing some structure to the markets. I don't think it's overreaching, which is the nice thing to say about Congress and getting their arms around this. And I'm sure that as it goes through the machinations of, both the Senate and the House, it's going to come up to some changes. We'll have to watch what those changes are. Hopefully they're all within that consistent body work of trying to keep this bill to be supportive of the industry. I want to just switch a little bit and go back to where we were a couple minutes ago. And, Mike Novogratz made some very interesting comments this week. He's obviously Galaxy Holdings, and he predicted 2/3 of the 1,900 crypto hedge funds out there are going to become, let's just say, family offices, right?
I mean, it is so out there, and I like Novogratz and know him. I've traded with him in my prior career, but the reality is when you are trading those other coins, in which I don't want to use the word that we normally use to describe them, and those hedge funds in DeFi platforms have shown tremendous return, but the underlying assets had dropped 90–80%, and majority of the funds take some kind of leverage, or if you haven't taken a leverage, you're down 80–90%. Guess what? The folks gonna withdraw. So he's not too far away. I mean, our assumption is about that, or a little bit higher percentage of the smaller DeFi funds or one-dimensional funds will see some contraction.
So I think Mike Novogratz probably regrets having a tattoo of Luna on his arm, but he can have it removed. So,
well, he did describe that as he ate that humble pie. So yeah. I'm sorry, Robert, go ahead.
No, I admire Mike Novogratz. He's built a great financial institution which will survive this bear market. Yeah. And what happens is that bull markets follow bear markets. It's cyclical. And we're going to have a fourth wave, which will be based on protocol innovation. 90% of 19,000 tokens will go out of business. Maybe 1/3 to 2/3 of long-only hedge funds in the crypto space will go out of business. But, you know, I grew up in a long-short environment, you know, where we always hedged our risk. We always analyzed the risk. We always put in stop-loss orders. We always looked for risk-reward ratios that were attractive. And so even in the crypto space now, there's liquidity premiums in Uniswap that offer people 60% to 500 to 1,000% return on investment if you can afford to take the liquidity risk. There's wonderful protocol innovation, you know, based on Algorand zero knowledge proof, based on cross-border chains, cross chains, and there's all kinds of significant dApps, decentralized apps on the horizon. Visa, MasterCard did 2.5, 3 billion last year of crypto transactions. This year, they're on target, on track now to do 30 billion, next year, 300 billion. And they're going to create another billion wallets between the two of them. So we're going to have a mainstream adoption in 23, 24, 25 of crypto, regardless of how deep this crypto crash is. It's going to be followed by a key reversal after a capitulation bottom. So we're getting ready for the liquid side. In the meantime, we're staying illiquid in SAPs. And I think that's the right way to go, is wait for the bottom before going long liquid crypto.
Exactly. And don't forget the announcement from Fidelity for their 401k and IRA plans. Adoption is here. The regulatory clarity is getting done. So I will definitely agree with Robert that after the bear market, there will be bull, and you got to be careful where you invest in your funds.
And I agree with that fully. Talking about crypto and talking about Mike Novogratz in particular, he also made the comments this week that he remains bullish on the crypto industry, primarily because of the adoption rates. And I think you did a very nice job there, Robert, a minute ago, spelling out what Visa was experiencing, what they're anticipating. But let's talk about adoption, if you would, because I think there's two levels. One, there's individual adoption, and then secondly, there's institutional adoption. And they're not both the same thing. So perhaps you did a great job. I would say the Visa example you gave a minute ago was probably more of an individual adoption as opposed to an institutional. Could you talk a little bit about the institutional markets and what's going on there?
So the ETFs are getting approved over the next 6 to 12 months that are in the pipeline. Obviously, there's a compliance clarity issue that'll be cleared up during the summer of DeFi, and the fall legislative season will clarify. And probably by December, we'll have legislation that will be fully clarified in it, and encourage next year in 23 institutions to come back into the market. Now, I don't expect pension funds to go to 10% digital assets in the next 5 years, but in the next 5 to 10 years, absolutely, you will see foundations, pension funds put in 1 to 5%. Why? Because it increases the Sharpe ratio. It's a true diversification. If you look at the historical coefficient of correlation between digital asset class and traditional asset classes, it's a true alternative that increases the total portfolio Sharpe ratio. So we will inevitably, because of Harry Markowitz's Nobel Prize in 1990 for the work he did in 1953, and the work by Richard Thaler at the University of Chicago on the nudge theory of micro-incentives, a seminal paper in the field of behavioral finance, as well as Daniel Kahneman's thesis on behavioral finance. We're going to see widespread adoption because there's incentives that modify behavior. It's going to create new behavior, a new form of financial assets that will be used in all kinds of new use case scenarios. For example, we're investing in Del Norte, which is NFTs on real estate, and where the smart contract contains the deed and title, and it's scalable, can become the Zillow of Latin America. So we're bullish on Del Norte, and it was endorsed by Mayor Francis Suarez in Davos when I was there a couple weeks ago. We were very bullish long-term on digital infrastructure. And so institutions have to invest in digital infrastructure. It's Web 3.0. it's going to create a few $1 trillion of wealth in the next few years. It's just that we have a temporary macroeconomic disruption, which is obscuring our vision of the long-term future of digital assets. But I'm very bullish long-term.
Agreed. Agreed with majority of your comments. If I can add to that, there's not a day go by when the major institutions are adding some kind of effort on their either institutional desk or participation into ultra high net worth assets, from Goldman to Morgan to JP Morgan, you name it. Everywhere you see, there was one study, and I'm missing the name of it, which talked about up to 50% of known hedge funds are participating in some parts of crypto markets, and they're looking to enhance the infrastructure as a whole. And what percent, the question comes down to what percent of their assets, either hedge funds or major institutions, are deploying in this asset class. As long as they are within 1 to 5%, I think we will see explosion growth after this bear market going through the marketplace.
And it prompts an interesting question that Amir Raja posted up here a few minutes ago, and particularly with hedge funds. And he's asking, are there any reliable tools for measuring risk regarding crypto, or is it just, by seat of the pants?
No, there are. There are institutions who have come up with, every exchange has their own tools, which you can follow that. There are institutions like Messari, they have built their professional tools for risk management and assets thereof. Portfolios managers are coming up with their own tools to evaluate assets and asset classes. It's all being developed as we speak. There's not one, you can go and pick one up, but there are other tools that are available, yes.
Absolutely. So, Robert, do you have anything to add to that question about tools?
Yeah, so I also like Messari.io. Has a lot of great research tools,
yeah,
and metrics. So liquid market cap, volatility indices, and I think it's just important to diversify. But you have to be highly selective and conduct in-depth due diligence and leave no stone unturned. Go the extra mile in due diligence. And most family offices are not equipped to conduct this kind of due diligence. That's why they need to selectively find crypto hedge funds that can uncover value and anticipate market momentum and understand risk parameters. And I think that's critical. Most family offices want exposure to crypto assets until Luna, then they got turned off. So I think there's a market sentiment element where, it's better to invest when there's maximum fear and sell when there's maximum optimism. To be a contrarian, it's not easy to find the exact top, exact bottom, but there's technical indicators for crypto that show when markets are oversold and overbought.
And on this topic, we received another question. It's not quite dealing with the tools, but it's dealing with really the cyclicality of Bitcoin, and it's attributed to having and it just like looking at Bitcoin. Where are we in this cycle? Obviously, we're down towards the bottom. Is it going to continue going down? Is it going to come back up? Is it going to stay in this area for a long time? What are your thoughts, and how should people be looking at? And they're using Bitcoin, I think, more as a broader term for crypto.
So there's a lot of different. It's a great question. It's a huge range of market forecasts, ranging from the most bearish Scott Minerd, followed by Nouriel Roubini. Scott Minerd thinks Bitcoin's going to 8,000 per Bitcoin by the end of the year. He's at Guggenheim. And whereas Tim Draper thinks it's going to 200,000 by the end of the year. So it's a huge range. And the reason for the divergence is partly positions. Tim Draper's brilliant, but he's long Bitcoin. And so he's biased, huge cognitive bias. And on the other hand, of the longer term, 5-10 years, I believe he's right. It'll probably go to $1 million. But short term, I think Scott Minerd is right. It'll probably go to toward 12, 15,000, if not a capitulation bottom at 8,000 per day, and then bounce back to 10, 15,000. And then as soon as this regulatory cloud is cleared sometime this fall or early winter, we're going to see a huge resurgence of bullish enthusiasm for digital assets.
I mean, look, I don't want to talk against Scott Minerd, but he's also talking about his book. And there are other participants who are talking about that the Bitcoin can drop up to maybe 28,000. And I don't want to talk about Tim Draper either because he's talking about his book. So what I advise folks to do your own due diligence, look at how the pricing have behaved over the course. I mean, it's very well documented by now, the parabolic moves up and down for Bitcoin especially, and I can only speak to Bitcoin because that's what our focus has been. And every time there's a happening, which is a supply getting reduced, you see a big momentum towards the price going up. I'm a 100% agreement with Roberts that once the clarity on regulations come through, majority of the institutions, the pension funds and insurance companies will find ways to come into this participation. And the limited quantity of Bitcoin makes it what we all believe the price will be only one way. And you will see some deviation. You will see some major correction because that's the inherent in this product right now. But as more and more institutions come into play, you will see more stability in pricing, just like other assets have gone through from their initiation. Don't forget, I mean, it's been less than a decade plus, that's it.
Yeah,
We don't
understood.
have much history. The infrastructures, the legislations, the regulations, the compliance. And I can tell you this, there's not one major institution where the cryptos or Bitcoin is not being talked about.
I think that's very true. And you actually, Rich, just touched on a very important topic, one that was raised by Jennifer Warren. And it goes, she was asking, what do you define as digital infrastructure in crypto, both soft and hard? So maybe you and Robert would like to speak about that.
I mean, I can talk about that to see what happened in between 2017 to 2020. If you look at that time frame, there's a lot more custodialship started becoming more reliable. Prior to that, it was pretty much you trading from crypto wallet to crypto wallets, and it was more adopted at individual level who were very techie smart and they knew how to operate their techie wallets and whatnot. So custodialship, transfership, ownership, all that infrastructure, which we take for granted because of DTCC and SIAC and all the background in financial assets, all that's being developed as we speak. So when I talk about infrastructure, is that. On the other side of that, there are other participants who believe that the whole notion that you can leave your coins to a custodian or at exchange could be in jeopardy. Okay, so for that, there's a lot more alternative wallets. The coin wallets have come up. You have web-based wallets come up. You have hard tokens come up. So all those solutions being developed as we speak.
Right, Rich, I agree with Rich. And Fireblocks did a $500 million Series E round.
Mhm.
They're very well capitalized and growing very quickly. And Fireblocks specializes in crypto wallets that are hyper secure.
Yep.
There are other wallets that are getting financed that can actually resist quantum attacks in 5 to 10 years. Probably will, crypto will be vulnerable to quantum dominant cyber attacks. And so we have to build infrastructure that's hyper secure for the next 20 years, not just for the next 3 years with digital wallets. We need digital wallets that will be quantum resistant.
Yeah, I mean, quantum is another one.
Yes.
If we
Yeah,
can
we can take that.
if there's another topic on quantum computing and the hacking, I mean, we haven't seen nothing about hacking and ransomware. Watch out for all the bad actors, bad nation actors. That will open up not only the new vulnerability within the cryptos, the whole financial system and our medical data repository, all that will be challenged because what we do today is all based on some algorithmic based data security or our cybersecurity. and that could be penetrated.
That's
So
correct.
there's a lot going on.
We will get to the question in a second, but last year there's over $170 billion of defensive cybersecurity and over $190 billion spent on offensive cybersecurity. So I've been to Israel's Cyber Command in the south of Israel in the Negev Desert at Bangor University, and I've seen the future of offensive cybersecurity. So we have one question from the audience. Go ahead.
Thank you. I'm wondering if you would, if there are countries in the world that you would point out as good examples where the legal framework has been established that is supporting the stakeholder crypto and assets, and what would be the expectation towards the government side to take into account not only to have framework in place, but also, for example, to ensure that there is cybersecurity insurance.
So the question is coming from the representative in the United States for Estonia. What's your full name again? Mari Sprin. And she represents Estonia in the United States, here based here in the Bay Area, I think. Yes. And so Estonia is known for cybersecurity as one of their core technology clusters because, like Georgia, not Georgia in the south of the US, but Georgia in Eastern Europe was attacked by the Russian Federation. And so they developed cyber expertise like guard time. So I'm in the leadership team, just to give you a succinct answer, of the Government Blockchain Association, headed by Gerard Daché. And it's an amazing association, 50 governments around the world, over 60 standing committees. Government Blockchain Association is addressing that issue of cybersecurity for governments that are procuring digital infrastructure. Estonia, by the way, I learned last night, is fully digital government based on the blockchain, the first to be fully digitized on the blockchain. So they have a hyper secure environment, enterprise cloud security, as well as blockchain security. So I think governments have to adopt the blockchain maturity model, which is being promulgated by the Government Blockchain Association, as well as IEEE engineering standards and eventually ISO standards from the International Standards Organization to adopt best practices in cybersecurity for blockchain. Yes.
Marty, you posted a
Last question.
Go on.
Environment. What are these current and future?
Rich, do you want to take that?
I didn't hear the question.
You got to repeat it.
I'm asking when you combine fungible tokens.
Robert, can you just summarize it? Because we can't hear it.
Yeah, Robbie, you need to summarize it.
So it's a question about, yeah, he's talking about engineering standards for security for various protocols. So I'm not going to answer it because I'm not up to speed on the engineering standards, but I would consult the Government Blockchain Association and the IEEE, and they probably have the most current answer to that question.
I would think so.
It's an important question.
And it's an important question, but each protocols are being followed and developed either on Ethereum or on Bitcoin blockchain solution. And technology-wise, I'm not the tech guy, I'm a finance guy. So I will defer that to your government authority on that.
It's absolutely one of the operational risk factors of this industry.
Yeah.
It's a nascent industry. It is going to be hyper secure and quantum resistant, but it's not yet. And so this is part of the regulatory requirements, is that there be financial audits of cybersecurity. That's part of it. And I think that's a very important question you ask.